Good evening, everyone. My name is David Milanec. Today is October 9th, 2024. And for some of you, you may or may not know that means that we are actually just under a week away from personal tax deadline if you filed an extension. Um, if you are someone who still has not filed their personal tax return, please give us a call. Our number is 708-914-8220. We can help you out. Again, my name is David Milanec. I'm the president and founder of Katz We're a full-service CPA firm. As I said, October 15th is the personal deadline. One thing that often happens with people in relation to the personal deadline is that they have some difficulty sometimes getting all their documentation together. We actually can help with that. We have the ability to file a power of attorney. It is a limited power of attorney with the IRS. And what that allows us to do is any information returns that were filed on your behalf, so things like W-2s, 1099s, 1098s, income documents that would have been reported to the IRS, we are actually able to get that information for you. We can also look up your account transcript because sometimes people have paid ahead and paid in. And so once someone has paid in and it's on record, we can actually pull those records and be able to apply them to your return as well. So if you are stressed out, near deadline, obviously don't have everything together, once again, give us a call, 708-914-8220. We can definitely help you out. So I feel like it's best to just kind of talk about some examples of different people that we can help. So like an individual who is in a gig job, so like your Uber, your Lyft, your Instacart, all of those things. A lot of times these people actually don't realize it, but they are actually in fact a business and they're not aware of it. And the effect that has for them, on their taxes is that they will be required to pay not only income tax on the money they earn on the business income that they're earning, but then they will also be required on top of that to pay an additional self-employment tax, which is an additional 15.3% on top of the income tax for whatever you pay. So, for example, if somebody has $50,000 of earnings, that's going to be an extra $7,000 of taxes that person has to pay. Now, we actually have the ability to get you out of that if you're in that situation. Unfortunately, we can't do it retroactively, but what we do is we set you up as an incorporation, and then we file an election for you to be taxed as a small business corporation. And what that allows you to do is being taxed as an S corporation. Yes, it does create an additional tax filing requirement because you have a corporate filing requirement in addition to an individual filing requirement. But in addition, but what the benefit is for you is that you no longer pay that self-employment tax. So someone who has $50,000 of earnings and files on a Schedule C, they're going to pay about $5,000 of income tax, about $7,000 of self-employment tax. Same person, same income. We file it as an S corporation instead. The result is going to be that they will pay a little more in income tax. So let's say instead of $5,000, they'll pay $6,000 of income tax, but then no self-employment tax. And because it's an S corporation, it's a pass-through entity, so there's no corporate level tax either. So the end result is that person, the same $50,000 they earn, they end up paying half of the amount of taxes. So if you're in a situation where you are working but you're not having taxes withheld, then in all likelihood you are being paid as a contractor. And if you're being paid as a contractor, you're a business and you can take advantage of this. And my firm actually has a guarantee, and that is that we guarantee that if you come into our office and we go over your situation, we recommend that you incorporate. We guarantee that the fee that we charge you, you will save at least that much money on your taxes the following year. And if you don't, we will refund you the difference. So if you're interested in that, please give us a call, 708-914-8220. I do want to touch, though, again on the personal deadline and the power of attorney specifically. So that power of attorney can be very important because if you are on, let me restart. I apologize. The power of attorney can be very important because if you have documents that you are unaware of, oftentimes that can lead to a CP 2000 notice. Now that a CP 2000 notice is a notice from the IRS that says that you owe. Typically, it's going to say that you owe more because you didn't report income that the IRS has. So I've had examples of this where somebody sold a house and didn't know that they had tax reporting documentation that was related to the sale of the house. I've had situations where people had self-employment income. They weren't aware that the self-employment income was reported. I've had situations where people have had 1099-C, which is cancellation of debt income. They weren't aware that the income was reported. In various cases, like the 1099-C example, the individual I'm thinking of right now, had $110,000 of cancellation of debt income. Now, if we hadn't pulled his wage and income transcript, if we hadn't gotten that information and placed it on his tax return, the result would have been that he would have gotten a note from the IRS that would have said that he owed probably about $35,000 in taxes and then another $10,000 to $15,000 in penalties and interest. So $45,000 to $50,000 of tax debt. But fortunately, we were able to catch it. So because we caught that, we were able to report that cancellation of debt income and use a provision of the tax code, Section 108 of the tax code, to eliminate that cancellation of debt income so that it did not affect the taxpayer, and the net result was that rather than paying $40,000 or $50,000, that taxpayer ended up with a refund. I've also had situations where there was a sale of a home reported, and taxpayer had a refund originally, and the IRS was attempting to put the sale of the home on the return with no allowance for basis, no allowance for capital gain exclusion, which basis in a property is the amount you paid for it. When you sell a property, you don't pay taxes on the whole amount of the property that you sell. You pay taxes on the amount over and above what you paid for the property. And that difference is called the capital gain. It's basically if you paid $250,000 for a property and then you sold that property for $300,000, you would have a capital gain of $50,000 because the sale price of $300,000 less the basis of $250,000 gives you a capital gain of $50,000. So the sale of this home was reported, but was reported with no basis and no capital gain and no capital gain exclusion. Capital gain exclusion is each taxpayer is entitled to once every 2 years. They can write off up to $250,000 of capital gains for the sale of a home if they lived in that home for at least 2 out of the last 5 years. So in that same situation that I just talked about, where you have $250,000 of basis, you sell the house for $300,000. If you lived in that home for 2 out of the last 5 years, you can exclude up to $250,000 of the basis in that property, which means, not basis, of the capital gain on that property, which means that $50,000 capital gain is now completely wiped out and you don't owe anything. So when we get a situation like that, where we have a notice that says the sale of the home is being reported, the thing to do is to figure out how much was paid for the property, as well as if that capital gain exclusion applies. We then are able to significantly reduce or eliminate completely that capital gain. So in the example I'm thinking of, actually, it was actually pretty close to the numbers that I said. The person had a $320,000 sale price on their property. Their total basis came to about $275,000, and so they had a $55,000 capital gain, but it was their primary residence for 2 out of the last 5 years. So we were able to, between the capital gain exclusion and the basis in the property, we were able to take a potential $64,000 tax liability and reduce it to zero. So let me give out our website. You can see on my shirt, our firm is Katz Milanec. Our website is katzmilanec.com. That's KATZMILANEC.com. And if you'd like to schedule an appointment or have us take a look at your taxes, give us a call, 708-914-8220. Again, 708-914-8220. And another thing that I want to talk about, since we are very close to the tax deadline, is that this is, in addition to wrapping up the end of year, getting everything done, getting things finalized for your 2023 taxes if you haven't done that yet. This is also a great time for people to start thinking about, if they haven't already, start planning for their 2024 taxes. So if, regardless of your situation, this can be a thing that you may need to do. So if you're a business, hopefully you've got good records put together, and you have a good idea of what your profit is year to date and what you're anticipating your profit will be through the end of the year. And if you don't have that information, obviously you can give us a call and we can help you get that squared away and put in order. So once again, 708-914-8220 if you need us for that. But if you do have that information, now's the time you want to sit down and figure out, okay, let's say I have $100,000 of profit. How do I want to deal with that? Do I want to make estimated tax payments and cover the tax liability for that $100,000, which is an option? Or do I want to employ some different tax strategies to be able to reduce or potentially eliminate that profit so that I don't have to pay on $100,000 of taxes? So what might some of those strategies be? Well, one, for small businesses especially, one major strategy would be to purchase assets. So if you're a construction company and you need construction equipment, now's the time to consider buying it. If you're any type of company really and you need a company vehicle, now's the time to consider buying it. And if you buy the right type of vehicle, and that would be a vehicle whose gross vehicle weight rating is over 6,000 pounds, and if it is a truck, a pickup truck specifically, that pickup truck needs to have a 6-foot or greater bed. And believe me, the IRS will come out and measure with a tape measure if you try to tell them that it is and they believe that it isn't. I've actually had people lose their depreciation deduction that way. But if it meets the criteria, if you buy a vehicle that meets those criteria, then you can fully expense the cost of the vehicle in the year that you purchase it, regardless of if you paid for it in full, regardless of if you have a loan on it, whatever the case may be, you can still fully depreciate. So if you go out and you buy a $70,000 vehicle because you have $100,000 profit, you can take the full $70,000 of that vehicle as a depreciation expense in the first year that you purchased it against your profit, and the result of that is that it would then massively reduce your profitability for tax purposes, despite not really changing much at all for what you've done monetarily. Also, if you do take out a loan, let's say you put a $10,000 down payment on a $70,000 vehicle and then finance the remaining $60,000, and you have a loan on that vehicle, any interest that you pay on that loan till the end of the year, also tax deductible, also can be taken against your profit as a deduction, and therefore reduce your tax liability and generate tax savings for you. Other assets, obviously, computers, equipment, furniture. You could even go as far as buildings, although buildings you can't typically get a full 100% deduction. That is something that has to be depreciated over time. Although in some cases you can break down the building into its components, do a cost segregation study, and take portions of the building as more rapidly depreciable, and in some cases fully expensable in the first year. That is also something that we know how to do. If you're interested in that, it's called cost segregation. Give us a call, 708-914-8220. Again, 708-914-8220.